Welcome everybody to the new episode of Market Decoded with Phileas Prop Firm and our guest, as always, Jay from Derivative Trading, a professional trader. How are you doing, Jay, this week?
I'm fine, and you? Thank you. It's a pleasure to connect again. Hope you are doing well.
I'm doing very good. Are you better and more energized for this week?
I hope at the end of the week and a little bit tired again, but I'm better than last week. Yeah, absolutely.
Perfect, perfect. And before beginning this week's market analysis, let's do a quick review of last week's episode because I hope everyone who listened to it was able to benefit and take the silver trade opportunity that Jay told us last week. It was an amazing insight. And if you missed it, make sure to stay until the end of this week's episode because Jay cooked us again some amazing trading insights. Obviously, not financial advice. You take your own decisions, your own risk, but stay until the end of this video because you won't regret what Jay cooked us for this week. All right, so let's start this week our analysis with the US stock market that is gaining some traction. So what's going on, Jay?
Yeah, absolutely. The US stocks market gained traction this week. The bullish sentiment in tech sector being fueled by increasing expectation that the Federal Reserve might ease monetary policy next week. And you can see today again the MSCI all country index is now nearing a record level, lifted by improving market sentiment and a strong recent corporate earning in the US. And this have eased some earlier worries about tech valuations, and that's why we have a market right now on the run.
Amazing. So US stocks near all-time highs and pretty much as you predicted for last week, actually, a small decline before the rally. If you want to start trading futures without risking your own capital and get funded with the best trading conditions, join Phileas Prop Firm by clicking the first link in the description below and use the code PPYT at checkout to get the best discount available. Let's get back to the market analysis and what's happening in Europe.
On the flip side, yeah, in Europe, stock movement are showing a more cautious approach. The internal dissent within Germany's government, especially concerning economic policy, is posing risk for equity market, and particularly as far right is gaining political influence in Germany. This uncertainty could shake investor confidence, leading to more defensive market positioning. That's the main issue. But we just had some news from Germany, and things stuff are going to improve.
So, could we expect the same Santa rally and optimism for the end of the year, similar to the US stock market for the European stocks?
I think because we have France also, the French budget, which is another issue. So I think investor will be more defensive on Europe.
Makes sense, makes sense. So more cautious, more defensive on the European stocks for the end of the year, and more optimism coming from the Fed rate cuts for the US stock market. All right, so now let's turn to the Forex with the dollar being under pressure. So what should traders be looking out for and what could be the opportunities for next week?
Yes, absolutely. You're right. The US dollar weakness is primarily linked to hedge fund adjusting their position in anticipation of more dovish Fed stance that could include interest rate cuts next week. Additionally, fluctuation in the Japanese yen and shifts in Japanese bonds and yield indicate that broader expectations of monetary policy change. We talk about that.
Mhm.
It also worth noting that we might see a massive deleveraging in carry trade if investors reevaluate their risk exposure for 2026. That's the main danger for stocks for next year. And we have the Bank of Japan meeting in the coming weeks.
Indeed, so very important meeting to be looking out for. We will cover everything about it when the time comes and we'll update you guys with the most relevant and up-to-date news. So for our US indices traders, is there any risk for the next week or is it only for the beginning of the year?
Not for now. So Central Bank of Japan could raise interest rates. The market is pricing in 89% chance you have here on the screen that the Japanese Central Bank will hike by the end of this month. The impact in the market will be more in the first quarter next year, mainly in January, I guess. And for now, for December, no problem. But in January, we'll have to look look at it.
All right, perfect. So we'll cover this important decision when the time comes. And so we'll give you all the information you need to be prepared and to take all the best opportunities at the time. Let's now move for the trader's favorite instrument for the past week, the metals, the precious metals, as you gave us a great insight on silver last week. So what's going on in the gold and silver market?
Silver prices have certainly seen a considerable fluctuation this week. We talked about it last week.
Mhm.
Uh, it rise to record high this week before pulling back due to both speculative interest and anticipation of upcoming US economic data. But then strong inflow into silver-backed ETF have provided support for the recent recovery, and today it's better than yesterday. Conversely, while copper prices surged recently, one big bank, I can mention the bank, warns that this uptick may be temporary due to robust global supply and concerns about potential declines in Chinese copper consumption.
Okay, and so for all the traders who missed last week episode and did not benefit from the silver move, what's the outlook for gold and silver for the coming week?
I'm still bullish on both silver and gold for the coming weeks, and we will have some central banks back in the bid, mainly from China, I guess, but also in the Middle East. So I'm still bullish for the coming days. And if we have a cut from the Fed next week and a dovish comment from Powell, yes, this is going to bring more fuel to precious metals.
Yeah, so the most important driver will be the FOMC meeting and the Fed decision for silver and gold, and actually for all the assets.
Absolutely. Yeah.
And before going to the different scenarios of what can happen with FOMC, I believe you told me you still have one more thing to cover and a great insight to provide to our audience.
Yeah, absolutely. Corn is clearly bearish right now, and that's another stuff for your client. Reports suggest that the US corn crop is projected to be among the largest on record. The increase in supply signals could put additional downward pressure on prices, impacted farmers and traders. So don't buy corn or sell it.
Okay, so again, very good insight. Is it going to be a short term impact or how do you see it playing out?
For several weeks, I guess.
So it might be medium term
Long term.
trend. Oh,
Yeah.
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 Okay. So very important. So I think a lot of traders are not necessarily looking at these agricultural assets, but I believe when you have some news like this, can provide very good opportunity to diversify from only focusing on Nasdaq or it's
Absolutely.
yeah. So thank you for this very good insight. Perfect. So next week, obviously, we talked about it a few times already. Today,
Mhm.
the Fed meeting, the last meeting of the year. What are the market expectations?
As you can see on the screen, you have a 90% chance that the Fed is going to cut 25 basis points on interest rates next week. However, investors should be particularly alert to the significant drop in the S&P volatility, indicating a shift in institutional positioning ahead of the Fed meeting. In the meantime, you have US retail investors are continuing to accumulate stocks and ETF at a steady pace, contrasting with more cautious stance of institutional players. This divergence could lead to increased volatility depending on the Fed messaging on light of current market data. So what I teach to my students is when you have this kind of compression of the volatility, you should be vigilant. So for the Fed next week, we can have a spike on volatility.
Very interesting to see this divergence. And regarding the more cautious stance or institutional investors, is it still related to the short squeeze risk that we covered last week?
Actually, the short squeeze on mid and small cap in US stocks have started this week. However, regarding next week, we could have a more explosive move if the Fed has a more restrictive language regarding financial conditions. That's why we could have some surprise. For now, we have a market which is pricing 90% chance of a 25 basis point cut. for next week. But if Powell is more restrictive about the next cut, it could be a surprise for the market.
Okay, perfect. And can you give us both scenarios? Like if the Fed is more restrictive or actually open for even more rate cuts, how should traders be positioning themselves?
If it's a restrictive surprise, we could have a sell-off. But in contrary, if Powell opened the door for more cuts in the coming months, etc., so we could have a rally on stocks and mainly a short squeeze on small and mid-cap stocks in US, and you could have a big rally, and mainly on Russell index.
Okay, so you see, guys, we have both scenarios. The probability of the rate cut is pretty high, so it should not be a surprise there. But the main thing to look out for is the speech of Powell, which, as Jay mentioned, the two scenarios and how it could play out. So be very cautious and you can follow Jay's advice. Okay, so anything else for next week that the traders should look out for except the.
No, it's the main event, the FOMC. So we have to be patient and wait for the big event for next week. And then maybe we'll have Christmas rally.
Okay, so the Santa rally might begin after this if we have the opening of next rate cuts by Powell. Amazing. So you already gave us a lot today, Jay. Do you have a tip for the week with the professional trader tips like every week?
Certainly, investors should avoid making decisions based solely on technical chart analysis. While it can be useful to assess the market at a specific moment, it unfortunately overlooks the underlying factors that drive price movement. And as you know, as we mentioned a few minutes ago, next week, the main event is the Fed meeting. This is not in the chart. That's why you have to follow the main event. This is the same for economical data and stuff like that. This is likely the main reason for the high failure rate among retail investors, I think.
Very interesting take. Yeah, it makes a lot of sense. I think this is mostly common for retail traders to only focus on the charts. Maybe like 90% of the decision is based on the charts when the actual flows are driven by outside factors, like you mentioned. So, again, very good tips.
Absolutely. The first thing you have to do is to read. You have to read, and then you can use your chart if you want.
So, what would you recommend traders do to prepare before opening the charts? What kind of reading? Do you have some recommendations, maybe?
Of financial stuff, you have several websites on the internet for free, Bloomberg, Reuters, etc. I think I cannot mention everyone, but you have to read before. You have to read, and then in the last moment, just before to enter in your position, maybe you can make a small chart analysis.
So basically, what you're saying is you already decided which asset and
Absolutely,
which direction you're going to trade before even looking
absolutely,
at the chart. And maybe the chart are going to enable you to refine your entry point, your exit, and your
exactly,
management. But the
absolutely.
decision and the trade idea is coming from the reading, the macro, the fundamental stuff, basically, that actually drives the flows in the market.
Absolutely, absolutely. If you look at the chart, you are going to be attracted by what you are seeing. But if you read, you are going to understand what is going on and you are going to make the choice before to open your chart.
And actually, I think it's also very good advice, not only for the technicality, but also for the psychology, because you already made the plan before opening the chart and getting bombarded with dopamine signals.
Absolutely.
So, yeah.
Absolutely.
Okay, so amazing, Jay. Thank you very much for this masterclass. I hope everyone liked it. Please like the video, subscribe. All the links to Jay's services are in the description below. You see, he's a real professional trader. All right, so thank you for everyone who listened to everything in this episode. I hope you enjoyed it. Please let us know in the comments below. And if you want to start trading futures, click the first link in the description below to join Phileas Prop Firm to not risk your own capital. And as always, I leave you with the last word, Jay.
Thank you, everyone. It's always a pleasure. Don't hesitate to ask questions on YouTube and we will answer.
Perfect, perfect. I wish everyone a happy trading week and trade safely. See you.